Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Rehana, Earle and Earle Theochari.
I'm Rehana, Earle.
And I'm Earle Theochari.
Welcome to The Tax Factor, your weekly roundup of the latest developments in UK tax. I'm hoping there was no pun intended by the producers scheduling podcast 88, Earle. I think that's for the bingo players.
Yeah.
So, what's been going on? Whilst Margaret Thatcher was famous for saying, "This lady's not for turning," it seems our very own Rachel Reeves is doing a few U-turns and seems to be in a sort of rotation mode. And it's reportedly considering some changes to the non-domiciled regime, in particular the inheritance tax on global assets.
Well, she seems to be permanently turning at the minute. But we'll also be talking about a High Court judgment on VAT for school fees.
And Tax Freedom Day. Shall we get going then? So, Earle, I think, like everyone, governments do make mistakes, don't they? But I suppose the difference is their mistakes are much bigger and have a much bigger impact. A week ago, we were talking about the Labour U-turn on winter fuel payments. They have basically kind of given some pensioners in England and Wales back their payments. And if you want to know a bit more about that, then you can listen to last week's episode with Neil and Roger, who covered that in quite a lot of detail. But are we set to see more U-turns? And I think that's the question of this week. And speculation is centering on whether or not Rachel Reeves will be looking at the non-dom rules. And this is really sort of following lobbying by, mainly sort of groups in the city due to the exodus of a number of wealthy people, Lakshmi Mittal being one of them, or should I say being one of them who is considering moving out of the UK. Alistair King, who is the Lord Mayor of London, is said to be among some of the lobbyists, and he's coming at it from the threat that the non-dom changes have made to the attractiveness of the City of London. And recently, the FT reported that Rachel Reeves is considering reversing the decision, in particular to change the charges to UK inheritance tax on global assets of non-doms. Again, on the basis that officials think that it's this aspect of the non-dom rule changes that came into force in April of this year that are causing the wealthy individuals to leave the UK for more favourable regimes like the UAE, and Italy's been spoken about a lot, as well as Switzerland. But I think the reality of this is that it's not just individuals leaving the UK with the tax that they pay, but I think the real concern around the fact that these individuals create a lot of wealth in the UK because they are entrepreneurs and they create businesses and they provide jobs. And actually, these individuals leaving means that there's going to be a big impact on investment in the UK through kind of lack of business operations here, or those business operations moving outside of the UK. I think the idea behind this potential review, and I say potential because we don't really know if it's going to happen, this is just sort of, high level word on the ground, is really on the basis that the government wants to ensure that the regime that has come in is actually internationally competitive and that the UK does continue to retain and attract the best talent who are the ones that will be wealth creators for the benefit of the whole of the UK. Part of the question, though, is around whether or not it is actually the punitive IHT rules and changing those, whether that will actually be enough to keep people here, because obviously there have been other changes to things like capital gains rates, which might also be leading people, especially business people where income is generated through gains, to leave the UK. I don't know. I'm a bit sceptical myself, Earle. I'm not sure what you think, but I'm a bit sceptical as to whether or not we will see any real significant changes here. My personal opinion is that I think it's just too politically sensitive, having, as I said, already seen some U-turns. Plus, I think the non-dom rules, albeit it was the Conservative government that first kind of touted the change in the rules, being a very popular policy politically. Labour has been kind of going on about it for years prior to that in terms of transforming the non-dom rules. And I just think, given so much of our tax policy seems to be driven by politics at the moment, whether or not there's actually going to be any kind of change to the rules, I think we will have to wait and see.
Yeah, like you said, it's not just that it's, say, even one party. Multiple parties have gone on about changes to the non-dom regime for years and years and years. Now that it's finally here, it's the kind of thing where if you sort of renege on one thing, where does that lead to going forward? And what does that actually mean for the policy itself? Because once you start chipping away and say, okay, well, we won't touch this bit, then people will say, well, what about this other bit? Or what does that mean? And, it's not as simple usually with tax, as we know, just to flip something on its head and say, we'll just remove this part, because the UK tax system is very, very layered and intertwined, and it will not be as simple as we can just remove this bit or we can just not look at this bit, because everything has these branches that kind of go into everything, and then you'll have to look at multiple different tax policies to see how it affects it as a whole. So like you said, I'm not sure.
Yeah, we will wait and see. But there seem to be some non-U-turns, shall we say, from particularly in relation to VAT following a recent High Court ruling. Do you want to just share a bit more on that, Ellie? I'm sure people will be interested.
Yeah, so this week the High Court ruled that the VAT that is now charged on private school fees does not breach children's human rights. So therefore, all private school parents are going to have to still pay VAT on their fees. So there were 3 different claimants brought this appeal to the High Court in April. One of those were parents with children who had special educational needs. We'll call that SEN from now on. And there are 2 groups that were from different religious backgrounds. Basically, the High Court has ruled in favour of the Chancellor and has said, actually, the government can charge that 20% VAT on private school fees. And the reason that they said it wasn't a breach of human rights is because it's actually imposed on the fees. It's fees paid for the provision of educational services. It's not really anything to do with the fact that your child either has SEN or actually that there is kind of a religious aspect to why you would prefer to go to a private school, which of course is what the other barristers were arguing. And actually they did say that if you then look at state schools, it's not necessarily fair that there are, I didn't even realise necessarily that there's over 1 million children with SEN that are in the state sector. And absolutely there might be better provision for them in private schools, but it's very unfair to those children if there are other children who have equal special educational needs that need to be taken into account, that they're actually getting an advantage above and beyond all of those other children who also need that help. It was very interesting. I'm no lawyer, so I don't know necessarily what the entire argument was about how it breached a human right necessarily. But as you can see, the judges didn't agree with that. And they said actually that the obligation to pay that VAT still doesn't hinder the access to private education. So yes, adding extra cost on it, you can talk about the societal impact of that and whether that's only helping the wealthy or whether it's the people that can already afford it. And, it kicks people out who are kind of really scrimping and saving to send their children to private school. You can look at those kind of social factors, but in terms of the access to the private education, the actual access does not change. Whether you have varying religious backgrounds, whether you have SEN or kind of any other reason, you can still get it. It's just that it's just more expensive now. You have that there. Although all of the claims were dismissed and they were separate, they can actually apply for judicial review. I don't know if they will necessarily, but it was an interesting thing to see the lengths that people will go to kind of keep their children in private school without having to pay that extra fee on top.
Yeah, I mean, definitely an interesting case. Obviously, I think we'll probably still see more to come on this. Obviously there are 2 camps, but a lot of people who feel strongly that you shouldn't be taxing children's education and others who agree that this is the right thing to do. But I don't think that will probably be the end of it in reality. Speaking of tax rises in general, so Ellie, a question for you. How much do you think in employers' national insurance was raised in April of this year? Take a guess.
Oh, I couldn't take a guess. I'm assuming it's massive. If we take it to it's certainly in the billions.
Yes. It was 2 billion raised in April alone. And this is really actually before the full impact of the employer national insurance rise was felt. And then on top of that, inheritance tax was up by 14% in a single month. In reality, real increases in the tax intake being seen across the board in the last month or 2, primarily obviously to increases, but also again the frozen thresholds and also the rising costs of goods, which is essentially kind of being passed down to individual and businesses and creating actually a lot of pressure. The latest HMRC stats for tax revenue, I think this is just interesting for people to know, show that employer NIC actually brought in 12.6 billion for the month, which is actually the highest figure ever and was up from 10.5 billion billion in March 2025. And this was an additional 909 million compared to this time last year. In terms of the policy around raising the employer national insurance, and part of that being trying to plug this big tax black hole, it certainly seems to be contributing in the right direction towards that. But I think what is alarming, and I think what was touched upon by both Roger and Neil last week, is these figures don't really sort of take into account the full impact of the increases that were put through. But what we're seeing is that unemployment has risen, as Neil and Roger talked about last week. And so I think the fact that we're seeing the increase in tax take on NIC, the opposite side is the employment increase. And I think it's going to be about continuing to sort of balance the books there and what's going to drive economic growth. Tax take is definitely continuing to rise, though, as we would expect, with figures for April 2025 hitting over 80 billion, which is up 4.3 billion on the same period last year. Whatever Rachel's doing is clearly increasing that tax take to plug that black hole. I think one other fact that is really interesting and sort of stands out is the inheritance tax, which was up by 14% in a single month, and actually marks one of the sort of biggest inheritance tax takes kind of ever almost. Obviously, IHT is affected by the size and value of the estates that are being subject to IHT, and so can obviously the payments can vary sort of month on month. But regardless, I mean, these are sort of record numbers in tax take in reality. Yeah, we're definitely seeing that increase, that plugging of the hole coming through various different sources, including stamp taxes as well, and VAT, which has obviously sort of gone up as well, primarily due to inflationary price rises on various goods and services. Those numbers will continue to increase, particularly with thresholds continuing to be frozen.
Yeah, those are, it's sometimes, even though we work in tax and we do see these numbers quite a lot, they are such huge numbers, and those increases for something to have gone up by £2 billion, that is enormous. And as we keep saying, and especially in Roger and Neil's podcast last week, they spoke about the spending review and what the plans are for spending. And Rachel Reeves is really going to have to deliver on what she said she's going to spend on, because if we're seeing £2 billion, and that's only in a very short period of time, 2 billion extra, the taxpayer is going to want to understand, where has that gone? What is the benefit to our public services, or wherever it is that she's going to spend it? So we will see. And sorry to be all doom and gloom, but speaking of taxes and where they are all going, so every year we have Tax Freedom Days. For those that aren't familiar, Tax Freedom Day marks the day when we have earned enough during the year to cover our tax bill. And unfortunately, it is falling later and later with each passing year. This year, Brits had to put in 162 days of work before their income became their own. This was only the other day, which is a little bit depressing, especially when you look at about 5 years ago. It was about 3 weeks earlier, and that was before COVID. What it's actually showing, and Rehana, you touched on it just now, fiscal drag is pulling millions more into the higher rates of tax, and therefore it takes longer in order for you to meet that tax burden. The Adam Smith Institute, who do quite a lot of the data analysis on Tax Freedom Day, said that actually it was 21 days earlier in late May before the pandemic, and back in 2009 it could fall as early as the 18th of May. So we have moved pretty much a month on. It said that this year each British taxpayer will have to work 6 days longer before their earnings become solely their own, which means, and this was horrifying to read, the tax burden could actually be higher than it was during World War II, which is awful. You
think we're going forward in time, but we seem to be going backwards.
Going backwards. And James Lawson, who is the chair of the Adam Smith Institute, said that Britons are now working nearly half the year just to pay their taxes, and that's only getting higher. So having a system that consumes 162 days of the working year cannot go on forever, because you look at it, and if you think in the economy, you have to really cut taxes. That's what you have to do. So up until 11th of June, every single penny a taxpayer earned went to HMRC and the government. Those frozen income tax thresholds really are such a horrible stealth tax. And that's a primary reason why it's taking so much longer for people to pay their taxes off. When they're also looking at that data from the Office for Budget Responsibility, they wanted to look at when they think Tax Freedom Day will fall in the future and possibly up to the end of the decade. This kind of made me feel a bit sick, actually. It said by 2030, it believes that taxation could surpass 50% of taxpayers' net incomes. It would be the end of June before you've actually paid off your taxes, which is just awful.
That is quite depressing, isn't it, when you think about it?
You think about it and you just think, oh my goodness, why? It's only been a couple of days that we've been earning our keep, Rehana.
Yeah. Yeah. It'd be really interesting, and I don't know the answer to this, when it kicks in other countries.
Yes. There must be some data.
I'm sure. And maybe we could,
yeah,
exactly. Maybe we can touch on that in the next, or someone else can touch on it in the next episode as to when that actually happens in other countries. But as you say, Earle, pretty depressing statistic, isn't it? Given everything else that's kind of going on. Yeah, I think we sort of touched on the fact that Rachel has set out her spending review and spending plans, though. So now we know that for half of the year, all of our money is going to the Treasury coffers. Hopefully, we're going to see some output from that. I mean, she's obviously talked about putting money into transport networks, defence, energy, etc. So from that perspective, all very, very welcome news. But obviously, the proof is in the pudding of how all of that sort of stuff improves. The other thing that she's spoken about is putting more funding into HMRC to hire additional staff over the next 5 years and to overhaul their very ancient IT infrastructure, and to focus on, a topic that we've spoken about a lot as well, which is the sort of poor customer service that people feel that they are getting from HMRC. And so hopefully, we will see some improvements there. But back to Neil and Roger again last week and their musings on the amount of time that it will take to claim money back from pensioners on the winter fuel, a couple of £100 here and there. If all the new funding goes into that, then it's probably going to be a little bit of a waste of time and energy and effort. But sticking with HMRC, so there's a new boss in town, so John Paul Marks. And interestingly, he received a bit of a grilling from the Public Accounts Committee recently. There were lots of questions about the phishing attack that happened. So I don't know if people are kind of aware of that, but 49 million was stolen by cyber criminals in a pay-as-you-earn fraud targeting taxpayers' online personal tax accounts. And there were a lot of questioning around how HMRC had dealt with that, the transparency around that issue. And, Marks was basically sort of reassuring the pack that he welcomes scrutiny and openness and wants to kind of move forward in that direction going forward. HMRC have got plans to develop a dedicated fraud prevention centre to combat cyber criminals, which is obviously something that, everyone is experiencing at the moment, so that similar incidents don't happen. But, they reiterated that of the 100,000 taxpayers that were hit, none had actually had any money stolen personally from their own accounts. And actually, it's a very, very small percentage of taxpayers that were actually impacted. So only 0.2% of total taxpayers. So obviously, HMRC still have a lot of work to do. Again, we've touched on that in prior podcasts, but the funds that Reeves has earmarked will hopefully support all the improvements that we expect and hope to see.
Let's hope. So to finish off, we're coming back to a classic tax factor topic, making tax digital. So given the rules come in next April, it has become apparent that there's quite a lot of people out there who might be affected but don't really know what the changes mean for them. So a number of leading professional bodies, the ICAW, CIOT, STEP, they've all issued guidance on the topic as part of their professional conduct in relation to taxation. Some of the issues that they addressed included things like responsibility for oversight of client data, checking the veracity of client submissions, and quite a strongly worded warning not to submit nil quarterly updates because HMRC won't actually allow these to be amended, and this could result in penalties. And then going on from there, when you sort of read through the guidance in a bit more detail, the whole penalty regime around it, whilst there is the regular tax penalty regime and it will work within those confines, it's because it's brand new and there are going to be teething issues and lots of people are navigating a totally new tax reporting framework with their clients. There are likely to be issues, and these bodies were warning HMRC that they have to be cognizant of that, and also that they need to be working with the taxpayer and with agents rather than working against them. So what they've done is they have put together it's called a series of frequently asked questions. So that should help with some things. But, it's a good thing that they've done this because ultimately, as I said, with any brand new system, it's not going to work perfectly first time and there will be mistakes and it will be a learning curve. So hopefully HMRC will be open to collaboration and continuing to add to that FAQ if needed.
Yeah, I think that would be very welcome, and I think there's still a lot to be done on the MTD space. But with that, Ellie, I think we probably whittled on for long enough. So that's a wrap for this week's Tax Factor.
The Tax Factor from Blick Rothenberg.
For the latest updates, insights and reactions to the big tax stories, don't forget to visit the Blick Rothenberg website. It's regularly updated with expert commentary, sometimes from me and Rehana.
If you're lucky. Michael Holland, one of our US tax specialists, will be in the presenter's chair next time. So expect some strong opinions and cross-Atlantic insight. As we know, there's a lot going on in the US. We're also welcoming a new voice to the podcast. Suzanne Briggs will be making her Tax Factor debut. So good luck to Suzanne.
Oh, Suzanne is the best. So wishing her lots of luck. There's only 2 more episodes to go before we head off for our summer breaks. Our final episode for the season drops on July 4th. It's our usual end-of-term report card. So Nimesh and Heather will be going through everything that's been going on during the year. And I think we probably know what might be coming up. We've got a bit of non-DOMs, winter fuel, HMRC, child tax allowance, on and on and on.
So we hope to be back in the autumn, don't we, Earle? But for now, it's goodbye from me.
And it's goodbye from me.
That's the Tax Factor. If you enjoyed the Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.